Thanks, Sam, for joining me today. To kick us off, do you want to introduce yourself?
Yeah, so I'm Sam Kirschner. I'm currently a operations fellow at Gigascale Capital, which is a climate tech fund. But I've got a long background just within venture capital. I like to say that I have a blend of operations and data combined with venture capital kind of expertise. And I'd like to blend all of that with just my love for people. And being able to help support founders and folks kind of create the things of their dreams.
Cool, love that. And I brought you on today to talk about startup accelerators. And you have experience, I think, working on 4 startup accelerators. I worked with you on ODX. You're my manager. So for the audience that's listening, so that's how we're connected. And but yeah, I would love if you could give maybe a quick overview of all the work you've done on startup accelerators.
Absolutely, yeah. So I really started on my interest in startups back in college. I found out that you could be an entrepreneur and not have a boss, and I loved that idea of not having a boss. And so that was kind of the thing that initially got me excited. I'd always early on been interested in nonprofits as well. And I realized the best way to create a nonprofit is to just have a really good for-profit, and you use the proceeds to start your own nonprofit. And so, playing like the Bill Gates playbook. And so that's kind of really what got me down the startup path. But as I was on campus at Berkeley, I started learning more about startups and the ecosystem there. And we realized there was just a big hole because it was very hard to know where to go to start companies. And there's tons of students who had brilliant ideas of projects, but they just didn't really know how to actually make it into a company. That process of being like, is this a good idea? Is this a thing that we can commercialize? How do we get our first users? Like, how do we just get funding? Like, all of those things were just so murky and hard to understand. And so what we realized was there was an opportunity to create an accelerator for the campus. So, let people apply with their different ideas and projects that they were working on, vet who we thought were the ones that had the most viable startup ideas, and then help them get to the next stage. And for the campus, that was really, getting people into YC, getting them some initial real funding from an external investors, or, just validating whether they could even have customers. And so that was the birth of Free Ventures, which was the first accelerator that I worked on. You have spoken to somebody else who's currently running Free Ventures. It's, I think more than 10 years.
Yeah.
I think it's almost exactly 10 years since we started it now. And it's still running. Companies have gone on to get into YC, be backed by Founders Fund, Spark, KPCB, Version 1, a bunch of other folks. And then the alumni from those programs too have also just crushed it and, started companies that are backed by Sam Altman and, gone on to do really cool things. And so, a big learning there was, it wasn't just about the students, it was about actually the students running the accelerator. Has been one of the most impressive things there. So that program was greatly successful and kind of got my my feet wet in the startup world. From there, I went into data science, and I was a data scientist for 3 years. I wanted to just get a better sense of what it was like to operate. At the same time, one of my friends was starting the house fund. So Jeremy Fiance, who I started Free Ventures with, was starting the house fund, which kind of was really validated in part by building out the house fund and seeing the demand for capital on campus and the opportunity there. And so I helped nights and weekends with the house fund. I ended up going back there full time to help him for Fund 2 after being a data scientist for a few years. And that was really when I went all in on venture capital. I was with the house fund for about 2 years, helping them do the Fund 2 and building out a bunch of infrastructure and different things as an operations person on their team. From there, I went to Village Global. So I got to meet the team at Village, including Eric Torenberg, who we got to work with at On Deck. And they were running an accelerator. And so that was the second accelerator that I got to work on, which was 2 years running their accelerator program. We did about 120 investments over the lifespan of the Village Global Accelerator. And it worked phenomenally. I still think it's a great model for working with companies. It was remote, which was very unique at the time. This is back in 2019, pre-pandemic. We were working with companies all over the world. So we were much more heavily international than a lot of accelerator programs. We were also agnostic, and we worked with a lot of angels and advisors to come in who were helping one-on-one with the companies, which really helped us both scale it from an operational perspective, but also bring in a lot of deep expertise per company. And so that was a great program. And Dwayne was really the mastermind behind that. and was my manager at Village. And so, yeah, that was an awesome program. The companies from that have, continued to go on and do really phenomenal things. We had Invita Therapeutics, Maroxa was in that. We had Settle, which is a fintech company. We had Overflow, which is a really interesting payments company for the nonprofit space. So yeah, we backed a bunch of really, like, the list goes on and on. I could keep naming companies, but great program. And that really became ODX, where I got to meet you. We saw the validation for a program like this at Village and the ability to scale it up. On Deck, when I started at Village, was 3 people. By the time that I left, it was 250. So On Deck had just scaled phenomenally. And we were able to bring Village's accelerator over to On Deck. So we wound it down at Village. We brought it over to On Deck. And I really think of it as almost like an acquisition. Like, we took a lot of the learnings and moved it over to On Deck, and we're able to run it out of On Deck with a much larger infrastructure and team and capital set. So yeah. And then we ran ODX for about a year. It's 160 companies that we invested in over the course of about 8 months. Because of market conditions, we didn't keep running it. I can go more into depth on that. You know that part intimately. But we left there about a year ago. And then in this past summer, I helped out with the 4th accelerator that I've worked on, which was the House Funds Accelerator. And so I was a visiting partner there, helping them run a program focused on AI founders. And so, I almost struggle to call it an accelerator in some sense. It was 3 or 4 companies that we worked with during the summer. We had 3 companies in person with us in Berkeley and 1 company that was more remote. And it was almost felt like more like an incubation, honestly, like we were working so deeply with these companies. So that was the 4th one. That was a very long-winded answer to your question.
No, I think it was a great, just kind of show like the range of which, like, the programs that you've developed over the years. And in this conversation, we're going to kind of cover like 2 topics. The first is trying to unpack more of like your knowledge around like actually building these startup accelerators. And the second is around just like advising founders on how to think about like which startup accelerators to apply to and attend eventually. So first question is, I guess, like, when building a startup accelerator, what do you see as like the primary teams and what are the responsibilities?
Great question. Yeah. I think the teams just closely align with kind of the function of the program as a whole, right? Because they're carrying out the execution of the day-to-day. When I really think about these programs, I think about high level, there's kind of 2 parts. There's the program itself, and then there's essentially the funnel, right? And so you have an investment team generally, which is doing the application and processing of people through that pipeline, all the way from application comes in to, we're going and doing the investment. I think one of the things that Village did and On Deck did, and I think some of the best in class programs really do, is they actually go outbound, right? So it's not about just people doing applications. They'll go out and try and find founders and convince them to come into the program and be searching for people themselves. Some of the best founders that go through these accelerator programs, they don't think about doing it, and they kind of get sold into doing it. And so I would say half of our companies at Village didn't even fill out an application, right? Like, we found them through some other means. So that whole team, the investment team, is really critical in terms of just being able to make success. One of the things I always say about an accelerator program is the program itself is so much easier to run if you get great companies, right? And so the companies that you have, making sure that they're aligned with what the program is and what the program is going to offer is really important. If somebody really needs help day to day building out one component of your program or building out one component of their business, and your program doesn't support them in that, that's going to be a mismatch, and that person's going to take a lot of time. But if you really pre-vet these companies and not only make sure they're a good investment, but make sure that the things that they need are things that you can provide, then that makes the best investment. So that's the investment side. There's also program, right? And so within the program, there's a bunch of sub teams, right? Application infrastructure, building out any sort of automations or things that can help scale the rest of the team, scale the investment team, scale the program itself. You have person who's running the program. That's what I've done historically, who's kind of coordinating between all the different teams and making sure that everything gets done. You have marketing, which sometimes would be a part of the investment team, sometimes not. in terms of doing the top of funnel. You have the day-to-day program coordination. So sometimes it's like an operation associate or somebody. And then there's fundraising, right? Sometimes the investors will actually flip and become, fundraising coaching or working with the companies one-on-one throughout the program itself, which is probably the most common thing. Because it's really nice when the person who's vetting the company and meeting them and selling them also works with them. So you build a relationship rather than handing that relationship off. But yeah, that's kind of the high level of how I think about it.
Cool. And what elements do you think make for a good program? Like what dynamics are you trying to create within one of these programs?
I think one of the things that's really a big differentiator for these programs is community, right? The batch that you're in, the cohort, the vintage, whatever you want to call it. That community element is really valuable. And I feel like founders learn more from each other than they do other people or advisors oftentimes. And it's a huge value of what these programs are about, is just founders being able to have that camaraderie. A successful program in my mind, those founders will continue to meet with each other and be friends and support each other throughout many, many more, years of their founder journey. And I've seen that throughout all the programs that I've ran. I think that there's also the level of depth of help and how specific that help is. I think that, these sector focused programs are really interesting. And some of the things like the AI program, the House Fund did, Neo's AI program, Conviction, Sarah Guo's program in terms of their AI focus. Like, I think these are really interesting. And Andreessen's also done a good job of trying to create some of this more content specific, programming. And I think that's also true for the community side, right? Having a community of people who are building in a similar space around you can be really helpful for recruiting, for customers, right? For all kinds of different facets of the business. Those are the two that I think the most about. Obviously like check size and investment terms and, previous investments and the size of the alumni base, like some of those things can matter as well. But I think it really comes down to like, what's the community going to be around you? What's the quality of those people? And do you really love the partners and think you're going to get value out of the program itself?
Cool. And thinking long-term about like how startup accelerators win, I guess like what variables do you have to control for?
Great question. And I think the game's changing a lot, right? Like YC has always been the top. They're really the first one to build an accelerator, period. Reputation matters a lot. We have up and coming accelerators that I think are becoming kind of best in class, like Pear's accelerator program and Neo's accelerator program are two of them, which are both phenomenal. But it really comes down to the reputation of what are the founders that have gone through that? What have been the success metrics around it? I think a great question that a lot of founders can ask is, what percent of your companies have fundraised after this, right? Not every program orients towards fundraising as being a metric coming out of it, but I do think that just trying to understand the reputation and the outcome metrics is really important in terms of winning. Differentiating in terms of your value add is valuable, right? In terms of the investment terms, like I think what's interesting about someone like Conviction and Sarah Guo is, they've been thoughtful about how much are they even investing and what are the terms on that, and being really friendly there to just start building relationships and helping more people. So I think that's an interesting one. I think that's actually somewhere where YC's become weaker, is I actually think the 500K deal is not as good for founders as it might seem on the surface, because you essentially, when you have uncapped notes like that are of that size, you're really incentivized to raise at a much higher cap later. And a lot of VCs just don't want to pallet that in the same way that they did historically. And so, the amount of risk that you're forcing your future investors to take on is high, or you're forcing your founders to take on a lot more dilution. And so I think the investment terms have become more and more important. Previously, it was just easy to match YC, but I think that's actually not necessarily a good thing to do now.
Yeah.
So, yeah.
Cool. And in recent years, we've seen a lot of just like VCs enter or like create their own startup accelerators. Sequoia launched Sequoia Arc. Greylock just launched a program. I guess like what framework would you use to help a venture capital firm decide whether they should launch a startup accelerator?
I think for most funds, it's not a good thing to do. It's operationally intensive, right? Like a lot of the ones who have popped up recently, Andreessen, Sequoia, Greylock, these are huge funds. They have a huge amount of money to be able to throw at programs like this, right? And it's hard. It's hard to work with some of these funds because there's also signaling risk. And so I think that the fund itself should be asking itself, am I going to create signaling risk within the portfolio of investments that I make at an accelerator stage? And so if you're a multi-stage fund who has $1 billion under management and you need to own 20% of these companies, you're not going to do that via an accelerator, right? Which means that you have to heavy up for a future follow-on round. And you're not going to do that for every company, right? Because you would just do that up front. You're not going to guarantee that you're going to try and, lead their seed or Series A. And so it just creates a lot of challenges, I think, in terms of that structure. So I'd really be asking yourself, is this the best thing for all the companies in the program, right? Am I going to create negative signaling risk across our portfolio of investments for accelerator investments if we don't do follow on, right? And then really ask yourself, like, what's the value? Is it that you're trying to see more companies early, which I think is what these multi-stage funds are really trying to do? Is that the best thing for the founder, right? And do you want to put the amount of energy that it takes into building a program like this, right? Like, I think it's a huge amount of work to build the brand. Even for, Sequoia Arc, I think is doing great, but even in Andreessen, like, it's kind of confusing what some of these programs are, right? Like, yeah. I don't even fully know why someone would go to Andreessen, and I try and follow this market really closely. Greylock, like, I've lightly heard about it, but almost sounds like they're incubating things. Like, I know that they incubated Tome and some of these businesses, right? And so it's like, is it an incubation? Is it just a beacon to get application data? Like, what are these people doing to try and differentiate themselves? And I think most of the time it doesn't make sense unless you want to go all in on the accelerator model, or you're all in on early stage and being willing to do high volume there, which was kind of our play at Village.
Makes sense. Yeah, I haven't heard some of the things about some of these programs. Like, I know, like, A16 Start, I've only seen like 2 companies that have gone through that program. I haven't heard details about the program actually. I don't even know if it's still running. So,
and a lot of times it's tiny checks. Like, from what I know about A16Z Start, it's like almost like YC's startup school, where it's like a 50K check or something, or 100K check. And so the deal teams are really flexible, and it's really confusing to know why somebody would go to A16Z for that program and what they do and how it's valuable. But I mean, I think they could get better over time and it could become more of a beacon, but it feels more like an experiment than it does a really cognizant choice to make a program like this good.
Makes sense. And then kind of curious on your thoughts between like remote accelerators and in-person startup accelerators. I know we did remote on deck, and we had like a big retreat, but I mean, I think everything's shifted in person. So kind of curious.
I think there's a lot of value to remote. There's people who have families, people who, are in other countries that have visa issues, people whose teams are just in other places. And I think there's a lot of value in having these international programs that you allow people to be remote. That said, the value of being in person is insane. Neo has a really interesting program where they do 1 month and they'll help cover costs for people to come and stay. And they usually do it in like a somewhat remote location. Like, it was in Oregon before, they're going to be doing it in Copper and in Colorado in the future. And I love that model where it's like, do an intensive period together. For On Deck, we did a retreat or a kickoff, right? And I think that's one way to do that. But I think you need to do some in-person component, even if you have it remote, where you get everyone to come in person and then let people go back. So when we did our kickoffs at Village, we had people flying in from Nigeria, people flying in from India to come and join us for our kickoff. And that was 3 days. It was intensive. They spent a lot of time together. A lot of them would stay a little bit longer to spend more time with the program and spend time in Silicon Valley. And then they'd go back home. And I think that's really valuable. And I think you get a lot of the value of the in-person from just like that intensive week. So I think you got to do some amount of in-person right now. People are craving it. It creates a lot more loyalty and community amongst the founders themselves and with the team that's running it, the fund. Yeah. And so I'm very for remote, though. I think that it opens up the world of possibility to a larger set. And in the economy right now, it's hard to do international, but I do still think that there's pockets where it's really, really a good place to be investing.
Cool. We've mentioned probably like 10 or 15 startup accelerators already. The market is just very crowded. Kind of curious, like, if you had to start one from scratch, how would you position it?
Yeah, I mean, It's a great question. At the end of the day, I think the biggest value is just helping founders get to the next stage, right? And I think if you can really become value aligned in terms of how much you want to own the company, the entry price that you're getting for that company, and then what the founders really need for the next stage, helping them do those things, and then helping them fundraise, right? And so I always loved Village's Angel Accelerator. Like that was, I think, a really good model. And it's something that I've thought about pretty deeply, like whether that would continue to be a good model. I think it's hard right now with the ecosystem, just like there's not as many active angels. But really thinking about like how do you just bring in experienced operators to work side by side with these founders to try and advantage them. Like I think there's an opportunity to effectively be what YC was at the beginning, which was like really hands-on, smaller group, deeply helping people kind of network within a trusted group of VCs, and being a true light post there, right?
Yeah.
And being very thoughtful about the founders that you back and the quality of those companies.
Cool. And then the last few questions are around just like advising founders on how to think about like which startup accelerators to apply to. Kind of curious for startups thinking about just like startup accelerators versus like raising a pre-seed or seed from VCs. Like when should you consider like one route over the other?
You know, I think part of the value of an accelerator is it forces you to kickstart your company, right? And so there's a lot of people who are dabbling on the side, interested in an idea, apply to YC, apply to one of these programs, they get it, and then they're like, I'm going to do it, and they take the dive, right? And so like, I think if you're kind of on the sidelines and looking for an excuse to start or trying to get validation on an idea, it's great to just be able to apply accelerators, right? And so I think the value to the ecosystem, and I'm very pro having a bunch of accelerators, like it's exploded, and I think that's good, right? And I actually want to see accelerators that are first money into some of these companies. Like I think Andreessen or some of these are like a little bit less, they're doing more obvious bets, right? Whereas I want to see people who are taking the more less obvious bets and creating space for founders to start a company where they necessarily weren't for sure that they were ready yet, forcing them to take the jump. And so I think for accelerators, it's like, do you see value in it? Do you think this is going to be really help you get there? Is it going to be a good brand for you that you're really proud of? Do you like the people? There's more niche accelerators where the people are just great and you want to work with them. To really think about these people, think about what the long-term looks like. You talk to alumni and try and understand what it looks like for them to graduate, both on book and off book references. And then the deal terms, right? Like, is it, how much is this company going to own? If you do YC and you raise at a lower valuation, like they could own 10% of your company, depending on how the uncapped note converts. And so how much are you willing to give up to have them a part of what you're doing is really important. And I think founders in the early stages don't think enough about dilution and how much dilution they're taking on, right? It changes per sector. Some sectors you just need to take on more dilution to realistically get some of these things off the ground. Like climate tech where I'm working now, like I think you just need to take on more dilution because it's super intensive in terms of cost and R&D upfront. Now, if you can go the pre-seed route, you're going to save on dilution. Maybe you do a party round, you get a bunch of angels and you can do that. That can be a great route too, right? I think you have to be really proactive about trying to engage people and engage the folks that are around you. A lot of people don't lead pre-seeds. There's like a smaller number of funds who's going to lead a pre-seed versus lead a seed. And so the amount of help you're going to get is lower. But if you're confident and you're just one of these founders who can run through walls, then that's amazing. I think that a lot of VCs want to find founders who are just running through walls, and that's super important. And I think the pace of learning is valuable, but I've worked with a lot of founders via accelerators where they weren't obvious. It wasn't obvious that they were going to be a stellar founder. And it took them iteration and time and learning to get to the point where they became one of these unstoppable founders. And like, there's signs that they were going to become that, but I've seen people with those same signs not figure it out. Right. And so like, I really think of accelerators as betting on people before that potential is obvious. And so if you feel like you can go out and raise a pre-seed, like go for it, like go try, right? Like I think that's a good route. And if I had to coach somebody who is a stellar repeat founder on what to do, like don't do an accelerator if you don't need it. But if you think that's what you need, then don't be shy about going and doing one.
Cool. I really like how you're thinking about that. And then the second part of this question is just like when to go to like an industry specific accelerator versus industry agnostic one. So industry specific, like the House Fund and their AI accelerator versus something like a YC or Techstars or 500 startups.
I don't know why you wouldn't go to an industry specific one if there's one that fits in that is high quality.
Mm-hmm.
Now, let's say you're doing like food tech and the only food tech accelerators that are great are like really niche and not that widely known. I'd be like, don't do it. You know, like maybe you should still go to YC or go to one of these like better programs if you can get into it. I think that I would not do one of the industry specific ones if it just there wasn't a high brand one. Now, if you can do one of these programs like the House Fund's AI Accelerator or working with Conviction or someone like that, like I would for sure do that over a YC because it's going to be so much more tailored to you. The community is going to be more tailored to you. The investors more tailored to you. Their network of investors is more tailored to you. Like the whole thing is just going to be more focused in. And I really think that's the future. The future is more of these, vertical focused programs that are also high quality and with really good investors. Sheil Manat and his FinTech Accelerator, amazing, right? Like if you can work with Sheil, go work with Sheil. Like they're like, I don't know why you would be in FinTech and not work with him or take YC over Sheil. Like I would encourage founders to take Sheil over YC every day because his depth of experience is so much stronger, even though Stripe came out of YC. I think the reason to go to a more generalist program is that your customer set is more generalist. Like that's, I think, the biggest selling point for YC in my mind is that you can sell into their community, but they're also so big at this point that like there's so much noise. It's not like Stripe is working with every one of the 2,000 companies that's in YC. Maybe they're trying to sell them in as customers, but like they can't be customers themselves of all those companies. And so it's just really hard. The bigger these communities get, the more unmanageable they are, which I'm sure you have seen it on deck, right? Yeah. I really think that if you can do one of these more boutique programs, it's with a high value investor like a Sarah Guo or a Jeremy Fiance or a Sheil Manat, like that's what you should be doing.
Cool. And then I know you've edited a lot of these startup accelerator contracts, so I was kind of curious, like what are some clauses that founders should be aware of when signing these deals? Is there anything they should be maybe watching out for?
There's two. Fees is one, right? Some of these programs, it's like they invest $200K, but then they charge you $50K or something for the program. Yeah. It's a little shady. The way I just would think about that is like they're actually just doing a $150K investment. And so you should be thinking about what's the valuation that is, how market is that, right? Like, is that a market deal or market terms? So I'm not saying those are all bad, but I do think that you just need to really try and deeply understand what the mechanics of that looks like with respect to other programs and offers out there. The other component is essentially what it's going to look like when this converts at a priced round. And I think that this is not just for accelerators, it's for every founder. One of the biggest things that I see with founders is shock when they realize how much dilution they're going to take on by the time that they're going and doing a price round at seed or Series A. And they realize like, holy shit, I thought I had 50% of this company and I have 30 or 25, right? After you have to give like, a pool to employees and all these things. And you like really step back and you're like, I own so little of this business. And so I really think every founder needs to be super hardcore about understanding how much dilution they're taking on and the pre-money, the post-money, even for YC, like at what point does that convert? At what point do they get their 7%? Or, how does it really work, the mechanics of it? And this is one thing that's counterintuitive, but a lot of founders want to be cheap, right? And are trying to find ways to save money. Don't cheap out on like legal costs. It's actually one of the few things that I think like you just need to work with a world-class counsel on this, because I've seen so many founders get screwed over by working with counsel that just doesn't work with startups or doesn't work with really good ones, right? Yeah. And like there's 4 or 5 firms out there that I think you should go work with. It's Goodwin, it's Cooley, right? Like it's these lawyers that essentially have like an incredible brand, and get a deal with them, right? Have them defer 20K worth of fees or something, like figure out what other founders have gotten in terms of a deal and try and get that from them. But you need to have a lawyer go through that contract with you and flag anything that doesn't look market, because they've seen hundreds of these, right? And they're going to be able to tell you what's market and not. So
cool. And last question. I think I know how you're going to respond because you kind of touched on it, but which startup accelerators do you think will perform the best over the next decade?
if I had my money to invest in accelerators out there right now, I would put money into Neo. I think Ali is amazing. I know him personally. I've been tracking him for a while. He's incredibly thoughtful about how he's built and ran the team there. I've come up against him again and again in deals, and founders he's getting are really good. And I think that he has been very thoughtful about his approach. And I'm just very impressed with the companies that they're getting. And if I coach founders now, like working with Neo, I would take Neo over YC any day. I would probably put money into Conviction, Sarah Guo, in her accelerator. I think she is world-class and is just an absolute beast. And I think that AI is very interesting, right? In terms of just a category. Sheil at Better Tomorrow, I think his fintech accelerator is really good, and he has a very, very thoughtful approach to fintech. And I also love that he has an international footprint, and he's pretty agnostic around pre-seed and seed when it comes to his investments. So I would definitely back Sheil. And I'd probably throw a chip into YC because it's just a damn good index. Like, I would not coach most founders to go to them, but they continue to win so many good deals that I see. And the deal terms that they get and the breadth of investment that they have, like they have winners coming out of every one of those batches, and they're going to have winners that continue to be huge. Like the amount of momentum they have is really impressive. And I think Gary is a phenomenal leader. I'm really excited to see what he does with YC. I think he's already been doing some really exciting and good stuff for them. Yeah. And so the phenomenal thing about YC is most people could probably not name a single partner who's actually doing day-to-day deals on their team. And that's a feature, that's not a bug. The fact that they are just so well known for their brand and for their outcomes, it doesn't matter what partners they have. They're going to be good, and you're going to get value out of that program. And so I think a lot of people crap on YC, and investors have problems with them. And even me, like I wouldn't probably encourage every founder that I would meet to go to them, but they are a good program at the end of the day. They've done a good job. They're good to their people. They're super high integrity. And there's a reason that people want to beat them, is because they're the best, and they're really one that's formidable. And I think it does a very good job to set the tone of how founders should work, how VC should work with founders. YC is super founder friendly. I think that they really are thoughtful about how they approach the community, and I'm glad that they exist because they're such a mainstay and really set the tone for our ecosystem.
Awesome. Thanks so much, Sam, for joining me today.
Awesome. Thank you, Kieran.
Yeah.